Hi, this is Jeffrey Kurt Financial Group. Today is Friday, March 13, 2026. Friday the 13th, 2 months in a row, and certainly this Friday the 13th, there are some spooky, suspicious things going on in the markets. First of all, I want to just talk about how unstable the markets are and how they're just being whipped around by headlines, by the price of oil. The price of oil is being whipped around by the conditions in the Strait of Hormuz and other headlines on the oil-producing nations in the Middle East. But I want to point out some other bigger picture things that I think could influence future direction of stocks, bonds, commodities. Primarily, I want to talk about is that dealer positioning, option positioning, trader positioning, these type of things point towards a lot of hedges and a lot of insurance for lower prices already in place. So what's that mean? That means that we could end up with a pretty negative headline and stocks don't go lower as you would logically expect them to do. That doesn't mean it can't happen depending on the how bad the headline is, how dramatic it is, and all that. But there is a situation where a lot of hedges have been purchased, insurance, the thoughts of lower prices is already in place. So that could mean you get a bad headline and stock prices move higher and oil prices could move lower. And so that, again, the setup is there. That's not the prediction that's gonna happen, but I think that viewers should be aware that this could be the case at some point. But there's a measurement for implied volatility and a measurement for realized volatility. That implied volatility is very high right now. Historically, that spread is almost at an extreme. If it's not at an extreme, that again could set up for negative news not being reflected in lower stock prices. Another thing that's going on is that private credit markets, which is lending from outside the banking industry through business development corps and third-party lenders and like that, the private credit market is usually not a tradable loan, is being upset. And BlackRock and Morgan Stanley and some other companies have restricted redemptions out of their funds. This is kind of a popular thing. There are some integral funds, which mean they allow only quarterly liquidity and only at a certain level. I've used these for clients. I think there's some value in these integral funds. But right now, it's in the private credit, the bigger players right now are restricting redemptions. That could be a problem. I don't know if it goes beyond the private credit market, but something to be aware of. Again, as I mentioned on Wednesday, higher interest rates, that's going to be a potential problem as well. Lastly, just to point out, next Friday, the 20th, is options expiration on a quarterly level. It's typically a big thing that happens. Futures expire. Options on futures, options on stocks and indexes expire. And going into that could also chop markets up a little bit, up or down, with no regard to whatever the headlines are. Again, the headlines at this point do matter and they are influential, but I think I want to point out some of these things that are ongoing that could move markets different from what you would expect from a headline, good or bad. Have a good weekend. We'll leave it there. Thank you for listening. Please let us know any thoughts, any questions, and we'll be back on Monday. Thank you again for listening. Goodbye.